Hello, and thank you for joining us at the GSMA's Mobile for Development Foundation. My name is Chris Lowe. I'm a Senior Insights Manager in the GSMA Mobile Money team. I would like to introduce two colleagues with me today who are co-authors of the two research-based reports being presented today. We have Gianluca Storci, Senior Data Analyst in the Mobile Money team, who co-authors our report on mobile money, how digital payments have impacted economic growth, and Eugenie Humeau, Insights Manager in the GSMA Mobile for Development's Central Insights Unit, who co-authors our report on mobile money in Ethiopia, advancing financial inclusion and driving growth. Across the world, mobile money services are growing and growing fast. While it took the industry 17 years to reach the first 800 million customers, it took only 5 years to reach the next 800 million. And of that, 400 million accounts were added over the course of the pandemic. Today, there are 1.6 billion registered mobile money accounts. Our data shows that the habit of using digital payments enforced by the pandemic has stuck, leading to mobile money activity growth outstripping new registrations in many countries. In addition, consumers now use a broader and more sophisticated range of mobile money products, including international remittances, merchant payments, and bulk disbursements. Some of the key contributors to the growth of mobile money in the past few years have been regulatory changes in large markets. In Nigeria, for example, new licenses have seen many new mobile money players emerge, and with this, a 41% growth in the number of registered agents. Not only has it created employment for millions of new agents, but mobile money services are now accessible to more people in Africa's largest economy. Ethiopia is too undergoing significant regulatory changes, opening the market to new mobile money services for the benefit of everyone. Today, we will talk about the socio-economic impacts of mobile money across low and middle income countries, and in particular, Ethiopia. We'll cover insights from our latest global research, followed by our research in Ethiopia, a nascent and growing mobile money market and Africa's second most populous nation. These insights, as mentioned earlier, are published in two GSMA reports. The first one being Mobile Money, How Digital Payments Have Impacted Economic Growth, and the second one being Mobile Money in Ethiopia, Advancing Financial Inclusion and Driving Growth. The first of our two studies discussed today was conducted this summer. The study is a search for mobile money's impact beyond financial inclusion. It is an econometric analysis, examining the link between the adoption of digital financial services in low and middle income countries and long-term economic growth. It is based on two global, unique, and novel GSMA datasets on mobile money usage and regulation that covered the 2013 to 2022 period. Second of our two studies discussed today was also conducted in 2023. The study seeks to quantify the impact that mobile money expansion could have on various outcomes in Ethiopia. It also discusses the challenges in advancing mobile money services and highlights opportunities for scale, as well as identifying enabling conditions for financial sector deepening and best practices in mobile money expansion, as seen in other mobile money markets that might hold lessons for Ethiopia. This study is based on a mixed methods approach to the research that includes key informant interviews, end user focus groups, a literature review, and quantitative modelling. And I'd now like to pose three questions to my colleague Gianluca on his latest research that has formed the new report, Mobile Money, How Digital Payments Have Impacted Economic Growth. In your research on the economic impacts of mobile money in low and middle income countries, what have you learned about the impact of mobile money on the economy?
This report summarizes the results of an econometric analysis carried out by GSMA Intelligence, commissioned by the GSMA Mobile Money Program. The study looked for a causal link between the adoption of digital financial services in low and middle income countries and long-term economic growth between 2013 and 2022. The results of our study suggest that mobile money adoption had a positive and statistically significant impact on GDP. We found that an increase in the ratio of registered accounts to population led to a rise in GDP. We also found that higher transaction values drive economic growth, and greater use of ecosystem transactions does too, where ecosystem transactions include bill payments, bulk payments, international remittances, and merchant payments. The evidence from our study also suggests that mobile money network effects impact economic performance, meaning that the economic benefits of mobile money increase as a greater number of users adopt the service.
Your research focuses on the economic impacts of mobile money in low and middle income countries. How is this study unique?
Several research papers and empirical evidence have highlighted the positive social and economic impact of mobile money on individuals, households, and businesses. And while the micro-level effects are well documented, the macroeconomic impacts of mobile money are much less understood, particularly in relation to GDP growth. Economic theory and previous literature have established a link between financial inclusion and economic growth. However, there's a significant evidence gap on whether digital forms of financial inclusion, such as mobile money, have a similar effect. This report is likely to be the first of its kind. It relies on two global, unique, and novel data sets on mobile money usage and regulation. The analysis is based on country-level data from 133 low and middle-income countries from 2013 to 2022. For data on mobile money, the study uses the GSMA Global Adoption Survey of Mobile Money, which is the survey behind the State of the Industry report on mobile money. And this covers 83 countries where mobile money was available between 2013 and 2022. The report also uses data from the GSMA Mobile Money Regulatory Index.
Considering your study into the economic impacts of mobile money in low and middle income countries, what are the implications of your findings?
Our study has shown that digital financial inclusion can drive long-term GDP growth, just as traditional financial services have been shown to do. For policymakers, this means that removing barriers to mobile money adoption can support economic growth. For instance, implementing supportive mobile money licensing and know your customer regulations can drive the adoption of mobile money and boost economic activity. Our study found that higher average transaction values and greater shares of ecosystem transactions drive economic output. Many countries in sub-Saharan Africa have applied mobile money taxes to increase government revenue collection, but if higher taxation leads to lower average transaction values, then this can negatively impact economic output. Policymakers need to consider this effect when evaluating the net outcome of mobile money taxation. Mobile money is only accessible if individuals can access and use a mobile device, while mobile internet offers a broader range of financial products and services. At the end of 2022, almost half of the population in low and middle income countries were not using mobile internet services, while 1 in 3 did not use mobile services at all. For mobile money and digital financial services to reach more people in low and middle income countries and promote economic growth, barriers to mobile and mobile internet adoption need to be overcome. These include digital skills, handset affordability, relevance, and safety and security.
And I'd now like to hand over to my colleague Eugenie and ask a few questions about her latest research in the report Mobile Money in Ethiopia, Advancing Financial Inclusion and Driving Growth.
In 2022, less than half of Ethiopia's population had access to formal financial services, and only 5% of adults had a mobile money account. So this is around 5% of men and 4% of women, which is just a marginal increase from 2017. But recent market liberalization in the financial and telecoms industries has the potential to really transform financial inclusion and result in significant welfare and economic gains, as seen in other countries. And so in this context, we sought to quantify the potential socio-economic impact of mobile money expansion in Ethiopia, and we developed 3 scenarios for mobile money growth. One, high adoption, assuming that mobile money in Ethiopia will develop similarly to major mobile money markets such as Kenya and Ghana, resulting in more than 50% of the population adopting mobile money. 2, medium adoption, assuming that mobile money will develop similarly to mobile money markets that have 30 to 50% of the population adopting mobile money, such as Tanzania. And 3, low adoption. This assumes that mobile money will develop in a similar manner to countries with less than 30% of the population adopting mobile money, such as Nigeria. And so with these 3 adoption scenarios in mind, we looked at the impact of mobile money on 4 outcomes. First, poverty reduction. In Ethiopia, almost a quarter of the population still lives below the international poverty line. Mobile money adoption could lift 700,000 people out of extreme poverty under the high adoption scenario. And so this represents a 2.4% reduction in the national poverty headcount ratio. But importantly, the impact would be most felt in regions where a greater proportion of those in poverty live within 5% of the poverty line, such as Addis Ababa and Dire Dawa. Because in these regions, mobile money has the potential for a larger proportional reduction in poverty than in regions where a higher proportion of the poor are living well below the poverty line. Second, we looked at GDP. So mobile money could increase real GDP by up to 2.5% by 2030, equivalent to $5.3 billion. So this would mean GDP per capita would increase by $45. Third, we looked at tax revenue. So at 6.2% of GDP, tax revenue in Ethiopia is less than half of the sub-Saharan Africa average and well below the average of OECD countries. So mobile money has a direct impact on tax revenue by improving the efficiency of tax collection, and an indirect impact by allowing greater consumption, which in turn generates greater GDP and additional tax revenue. So mobile money could help increase tax revenue by up to 2.4% by 2030, equivalent to $300 million. And fourth, risk resilience. So almost 2 in 5 households, or 40%, experience an unexpected shock that impacts their livelihoods. And many are not able to do anything to face shocks, while others resort to coping mechanisms such as drawing upon savings, selling livestock or crops, receiving help from friends and family, obtaining credit, or eating a poor diet. So mobile money really is a way to digitize and formalize some of these existing offline coping mechanisms. And accessing mobile money can therefore improve resilience to shocks and enable households to maintain their consumption level.
It is recognized that agents form the backbone of the mobile money ecosystem. What does the mobile money agent landscape look like in Ethiopia, and what are the key priorities to improve agent networks?
Distance to an access point is one of the main reasons preventing people from opening mobile money accounts. And while Ethiopia has made great progress in expanding access points, it still lags behind other countries. Agents also face a number of challenges. We conducted field research with mobile money agents and found that a lack of liquidity in particular was the main challenge to running a mobile money business profitably. So there are a number of key priorities to improve agent networks in Ethiopia, including an increased number of agents in underserved areas, an active recruitment of female agents who are in general more successful at driving uptake among other women, faster KYC for agents and a review of the criteria for onboarding, to really balance quicker recruitment with ensuring integrity of the agent network, and partnerships with third-party organizations to use agent networks for other distribution services also has the potential to enhance their profitability.
You mentioned that only 5% of Ethiopian population has a mobile money account. Expanding access points through agents is important, but what can be done to stimulate demand and ensure that mobile money is more widely adopted?
So agents are one part of the equation, but in order to grow, mobile money needs to equally attract agents and customers for networks effects to really kick in. So there are a number of remaining barriers to account ownership that needs to be addressed, and these include one, a lack of awareness. Only 49% of men and 35% of women in Ethiopia are aware of mobile money. So this is the first step. But even among adults who have a mobile phone and are aware of mobile money, account ownership remains low. Two, lack of skills and financial literacy. Around 50% of both men and women in Ethiopia do not know how to use mobile money, and many have difficulties using a handset. Three, a lack of relevance. More than 40% of both men and women in Ethiopia prefer cash or have alternatives to transfer money. And there are also other barriers such as affordability or unreliable network that also prevent people in Ethiopia from having an account. So there is really a need for cross-sector collaboration to help tackle these issues if Ethiopia is to reach the high adoption scenario we mentioned earlier.
Once adoption reaches a higher level, what will be important to ensure people in Ethiopia actively use mobile money? And what are some of the untapped opportunities to boost usage in Ethiopia, and what can the country learn from some of the more mature markets?
Nascent mobile money ecosystems and markets often begin life with the availability of core services such as person-to-person transfers and cash-in, cash-out services through agents, shops, or ATMs. But successful markets have often widened the range of products and services beyond these core services to expand market reach. And in Ethiopia, person-to-person payments and person-to-government and government-to-person payments were introduced to the country early. The Productive Safety Net program is an example of G2P payments, government-to-person payments, and it offers support to households suffering from food insecurity. But other mobile money use cases remain limited. It's expected, though, that increased competition resulting from the recent entry of Safaricom's M-Pesa into the market could lead to further use case diversification, which would drive adoption and usage, especially in peri-urban and rural areas. So there are opportunities to prioritize emerging use cases such as savings, credit, and insurance to improve resilience to shocks and to target underserved segments of the population, such as smallholder farmers. Agriculture indeed is the backbone of the economy, with more than 60% of Ethiopians depending on it for their livelihoods. So access to mobile money can help farmers build a transaction history that would enable them to get access to loans, credits, or insurance. So such products will really be key for low-income or underserved populations to be more resilient to shocks.
This now concludes our session, so thank you very much for listening. You can find the links to our reports via the QR codes that you see at the bottom of the screen. And thank you to our sponsors, the Bill and Melinda Gates Foundation and UK Aid. And thank you very much for joining us today at the GSMA Mobile for Development Foundation.